All right, welcome back. This is episode 10, Invest Info, and we're going to title this one A Great Example of Investing in What You Know. And as you can see above, this is Peter Lynch. He's famous for this term. And Peter Lynch, he was at a mutual fund manager from Magellan, and he had an annual return of 29.2% at his time at Magellan, and that's a record. No one's able to get that type of return annually with the amount of money that he managed. And his 8 rules of investing are very simple. Small investors have a huge advantage, which is true. If you work if you work at a retailer and you see that retailer is making money, you work at a car dealership, you see that a particular car is growing, you have an advantage on Wall Street. It's not about being the smartest guy, smartest individual. It's just understanding that these stocks are companies. These are businesses, and if you see a business that's growing, you can see it before Wall Street does. You invest in it, you can profit it. I mentioned BJ's early, right? Being in that company and during the pandemic, seeing how much money it was making, and guess what? Earnings came out. It had a huge earnings, and the company reinvested their earnings into expanding their businesses, making their business grow faster, and it reflected in the stock price. It says know what you own. Cannot stress that enough. You have to understand what this company does that you own, and it doesn't have to be something super complex. And as I go on with the this video, I'm going to use an example of a company I was just I missed it, but it was so obvious right in front of my face. But it's okay. It says don't invest purely on others' opinions. Um, True. Peter mentions the fact that you'll take months before you purchase a car, or a year before you even purchase a home. But you hear somebody talk about a stock on a trade, and you go buy it right away. That's a lot of people's emotions. Uh, Mainly the retail investor just trying to get rich quick. You have to and also Warren Buffett says it's not about going against the crowd or with the crowd. It's about checking your facts and knowing your facts are right. It says focus on companies behind the stock, right? So when you purchase a stock, I mentioned it. Look up the CEO. Look up their history. See what this company is about. Where is this company located? What's their advantage? That's when you're owning something long term, and you plan to either get cash flow from dividends, or it doesn't have to be this dividends. Dividends are mandatory to invest, because sometimes it's better not to pay out a dividend if you could return if the company could give you a better return on your dollar. You know, Phil Town, he likes it best when a company use their additional free cash flow to expand the business even faster. Another one is share buybacks. You might hear certain people complain about share buybacks, that they're a bad thing, but they're a bad thing only when a CEO is buying back their stock at an overvalued price. If the CEO is buying back shares of the company when it's undervalued, that's a good thing. And of course, lastly is dividend. So how are they using that cash flow? He said, focus on the company behind the stock. Don't try and predict the stock market. Don't try and predict the market. This is true. You have people that gamble on the day-to-day fluctuation of stock price. Charts and analytics, and don't nobody can predict the market. The best way I could compare it is, let's go back to BJ's, right? I'm always using BJ's. Okay, so let's say BJ's had a particular day where it made a lot of money, right? And it had a second day where it made a lot of money. A third day we made a lot of money. On the fourth day, would you bet that it's going to make a lot of money? Well, it's still a 50-50 chance. See, the 50-50 chance is going to make money today or not make money today. But people think that because, how much money they made the previous week, or how much they made last year at this time, some type of reasoning that they could determine how much customers are going to go in the store that particular day, how much money they're going to make that particular day. They might go down today, might be up in today. We don't do that, We don't take bets on day-to-day price movements. or trading or buying options, trying to bet which way the market's gonna go, because it's just a gamble. Can you win? Yeah. You could also lose. More often you lose than you win. So, as Stock Compounder YouTube page was saying, take the Warren Buffett approach, which is to just slowly have our money compound over time. That's how we generate wealth. It says, market crashes are great opportunities. Absolutely. In March, when fear was hot, COVID was hot, everybody was fleeing the market. That's what was the best time to buy. If you look at most companies, their March prices compared to now, more than half of the major stocks companies out there, you'd have doubled your money, more than doubled your money if you just invested in March. And it normally takes a long time to double your money in the market, but March was a great opportunity to buy. And it's like that during a lot of crashes, and not only crashes but crises. So you do have crisis investors, and I mean, stock market crash it sounds scary because it's a crash. Really, it's a stock market sell off, a stock market sale. I only buy stocks on red day. When I actively do trade a very small portion of my portfolio, um, bulk of my portfolio is in a long term holding. But when I do trade a small portion, I'm only buying when it's red. If something falls 20, 30, 40%, I say no, this is a guaranteed buy right now. I don't tend to buy things when they're going green. Most of the retail investors do buy when things are going green because, just to be, they honestly don't know what they're buying, just buying pure emotions. It says, you have plenty of time, right? Be patient. You don't have to rush just because you heard a stock on a train, or just be patient. He mentioned, I believe, Walmart. If you'd invested in Walmart 10 years after the IPO, in his time, you'd have still made over 20 times your money. Says, you need an edge to make money. You have the edge. We have the edge, man. As a retail investor, we're on the ground. Now, the main company I want to highlight for the lesson is Dick's Sporting Goods. And if you look at Dick's Sporting Goods, and let's look at from in March. So March, let's raise this up a little bit. In March, Dick's Sporting Goods fell all the way down to, I could just find it at the bottom, 1346. And as of recently, the stock it's on a pullback now, pullback to 59, but it went from 1346 all the way up to $62.84, and that's Dick's Sporting Goods. I mean, I get products all the time for working out or sport or something like that, and I get it from Dick's. Now, you might say, but Modell's Sporting Goods closed down. Modell's closed. Why would I know? How would I know to pick Dick's over Modell's? Well, you can find out how a company's cash flow. Now, I'm gonna just briefly go over this, and then maybe in a later show, elaborate a bit more on it. But the reason Dick's Sporting Goods didn't go bankrupt and Modell's did was because of the debt. Modell's had a lot of debt. They couldn't pay back their debt. They couldn't generate enough cash to pay back their debt. And also, Dick's Sporting Goods are doing a lot of online sales. I mean, an enormous amount of online sales and generating cash during the pandemic. So I want to show you something real quick. If you find a company, something you understand, even if you didn't know how to do a balance sheet and cash flow, you're just working in this company, you see that they're making money, you invest. You'd have got a great return on your investment. You'd have had an edge on Wall Street, as Peter Lynch like to says. He says invest in things you buy. Very simple. Now, from a more technical standpoint, let's look at Dick's Sporting Goods. So I mentioned cash flow. Now, how do we get cash flow, right? So you can use Yahoo Finance app. It's a free app. We're going to type in the ticker right here, Dick's Sporting Goods. We're going to go to details. Go to the details. We're going to look at the financials. So we're going to view all. We're going to look at the cash flow. and we're going to look at the quarterly cash flow. So let me go ahead and sort of make this. Now, you can see here has net income. The TTM means trailing 12 month. But I don't want to complicate things too much. You could look up on how or what is cash flow, how to get a company's cash flow. But if you look at Dick's Sporting Goods, look at their earnings. They beat it in Q4 of 2019. They beat it in Q1 of 2020. Now, of course, they missed it. A lot of people missed Q2 because of COVID. But look what happened in Q3. They blew it out the water. They were making an enormous amount of money. And you could have checked out how the company was doing in terms of free cash flow by checking out the financials. So, you look at the quarterly financials in March for January, and you see that the company had free cash flow. Now, this 565,629 is in the thousands, so that would be about 5 billion or 500 million. No, this should be 5 billion, 5.6 billion in free cash. So during the pandemic, you'd have looked at the company, you'd have looked at Dick's, if you're investing in Dick's, and does this company have debt, or do they have free cash to play with? Not play with, but free cash to cover their debt if needs be. You'd have looked at them, you said, okay, they have free cash flow. Now, during Q2, and it have popped up with a lot of negatives, negative cash flow because of the lockdown pandemic situation. But if you had just understood Dick's Sporting Goods, if you worked in there, if you had a friend that worked there, if you shopped there all the time, you've seen all these sales, you just saying, wait a minute, people are buying. And look at this. It went from negative 274,000 to 1 million. 1,056,895, and this is in 1,000. So I think this is over $1 billion in cash flow, free cash flow. So that was reflected in the stock price. Stock went from 13 to over 62. So I thought I'd use Dick's as a good example. Always mention BJ's. So if you find a company, something simple you understand, you could always check out the cash flow statement. How well they're doing quarterly. Look at the earnings, and just keep investing. It's not super complicated. That's how come, as of yet, I don't really give out stock picks, because I want this to be an educational channel to understand the fundamentals of investing and how to buy stocks and how to approach buying companies, because that's what Peter Lynch do. That's what Warren Buffett does. Phil Town, Mohnish Pabrai. These guys don't give stock picks. Karl Marx, Bill Ackman. They tell you the fundamental rules of how to buy a stock, because you could find, as the retail investor, we could find things that they can't find by just buying companies that we understand before Wall Street does. Okay, that was episode 10, and I'll see you on the next one.